Hello and welcome to AE Accounting Tutorials. We are beginning a new series on IAS 23 borrowing costs. In this video, we'll be looking at the basic concept of this standard, the objective of this standard, the scope of this standard, some basic terms that we need to understand, and probably the components of borrowing costs. So if you are new to this channel, I will encourage you to subscribe to this channel, turn on your notification bell so that any moment I upload any new video, you will get notified on your devices. And also comment on this video for us to know how this video has helped you. Before we look at the basic concept of this standard, I would like you to understand some overview of this standard. Is that okay? Sometimes business would like to produce or acquire or construct any assets. Before they will be able to do this, this will requires a huge amount of money to do this. So for the business to raise money to finance this project, they have two options. Either they will raise money internally or they will go for external borrowing. So if they decide to go for external borrowing, this external borrowing will attract interest at the end of every year. So the question that we normally ask ourselves is that this interest that is on the external borrowing we go in for, do we treat this interest as an expense in a statement of profit or loss, or we capitalize it as part of the cost of the asset as a non-current asset in the statement of financial position? So when I talk of capitalization or capitalize, I mean adding the interest cost to the cost of the asset in the statement of financial position. So for instance, when a business go in for loan, okay, to put up a building or construct a building, so of an amount of $10,000, and the interest on this per annum is 1,000. That is 10% interest. So the question we are asking ourselves is that, are we adding this interest to the cost of the building to make it $11,000 in the statement of financial position, or we only recognize this in the statement of financial position and recognize this as an expense in the statement of profit or loss? That is where IAS 23 came in to solve this problem for us. So after going through this topic, you will get to know how a borrowing cost or interest relating to external borrowing will be treated. So the main objective of IAS 23 is to prescribe the accounting treatment for borrowing cost. Is that okay? So it is this standard that prescribes how we should treat borrowing cost, either in the statement of financial position or in the statement of profit or loss. The core principle of this standard is that an entity can only capitalize a borrowing cost if the borrowing cost is directly attributable to the acquisition, construction, or production of a qualifying asset, and all other borrowing costs should be expense. That is the core principle. So if the borrowing cost is in relation to either the acquisition, production, or construction of a qualifying asset, then that borrowing cost can be capitalized as part of the cost of the assets. So with this core principle, there are three keywords that I need to explain to you. Okay, so that brings us to some basic terms under IAS 23. So the basic term I would like to talk about borrowing cost. Borrowing cost. So what is borrowing cost under IAS 23? Borrowing costs are interest and any other costs that are incurred by entity in connection of borrowing of funds. That is the standard definition of borrowing cost. So borrowing costs are interest and any other costs that are incurred in connection of borrowing of funds by an entity. So if an entity decided to go in for external borrowing of an amount of $10,000 and there is an interest component or interest on that borrowing of 1,000, that interest is part of borrowing cost. And if there is any other costs that are incurred in connection to the borrowing of fund, that other cost is also part of borrowing cost. So the key two words here are interest and any other cost. So any other cost and interest are the two keywords in the definition of borrowing cost. Is that okay? The second word I would like to talk about, or the second word I would like to talk about, is capitalization. What is capitalization? Capitalization under IAS 23 simply means that adding the borrowing cost to the cost of the qualifying asset and recognize it in the statement of financial position. So if the cost of the asset is $1,000, you went in for loan to put up a building, and the building cost, let's say, $10,000, and then there is a borrowing cost on this building, and the borrowing cost is, let's say, 2,000. So the process of adding this borrowing cost to the cost of the qualifying assets is what we call capitalization. Okay, so adding either the interest or borrowing cost to the cost of the qualifying assets into the statement of financial position is what we call capitalization. The third term I would like to talk about is a qualifying asset. Qualifying asset. So what is qualifying assets? Qualifying assets are assets that takes a substantial period of time to get ready for its intended use or sale. Okay, so if the acquisition, construction, or production of an asset takes a substantial longer period of time before the asset gets to its intended use or sale, is what we call a qualifying asset. An example of this qualifying asset is what you call made in order inventory. Inventories. So if the production of the inventory takes a longer period of time, then such inventory should be considered as a qualifying asset. That is what we call made in order inventory. So there are many. You can have manufacturing of plants. So if a business wants to manufacture a plant, and this plant takes a substantial period of time or a longer period of time for it to be completed, then we consider that as a qualifying asset. Example is construction of building. Before an entity will be able to construct a building, it will take a longer period of time, a year or two, or half a year before it will be completed. And that building can be considered as a qualifying asset. But if a business just go into buy a motor vehicle or acquire a motor vehicle within a shorter period of time, such motor vehicle cannot be considered as a qualifying asset. So these are the three basic terms I want you to understand. Is that okay? So after looking at these terms, I want us to look at the scope of this standard, the scope of borrowing costs. Okay, before we look at the scope of borrowing costs, I want you to understand this. Business can finance, or business can raise money to finance their project in different ways. The business can do this either through loan, through bonds, through debentures, through preference shares or capital. So if a business decided to raise money to finance its project, that may be an acquisition of an asset or construction of building. When this happens through loan, bonds, or debenture, the finance cost associated with this fund can be considered as borrowing cost. Is that okay? And hence be capitalized. But then if the business decided to raise money through a preference share or preferred capital, which is not recognized or classified as a liability, then such finance cost associated with the preference capital, preference share, cannot be considered as a borrowing cost. So when I talk about the exclusion of the borrowing cost, the scope of the borrowing cost, I'm actually talking about the exclusion. I'm talking about the exclusion of borrowing cost. So the first exclusion to this standard is preference capital, preference share, or preferred capital, or preference shares that is not classified as a liability. Okay, that is the first one. The second exclusion to this standard is cost of equity. Cost of equity. That is imputed cost of equity. I told you that the business can decide to raise money to finance its project through its own equity, that is internally generated money, or goes for external borrowing. So if a business finance money through its equity, the finance charge associated with the equity cannot be considered as a borrowing cost. Is that okay? So the third exclusion to this standard is short-term inventories. Short-term inventories. Short-term inventories. That is inventories that are manufactured within a short period of time. Okay, we say that before you'll be able to capitalize a borrowing cost, okay, or a finance cost. That finance cost or finance charge relating to the asset must be a qualifying asset. And a qualifying asset takes a substantial period of time. So if the production of inventory takes a very shorter period of time, then that is an exclusion to this standard. Qualifying assets measured at fair value. So a qualifying asset measured at a fair value accounted for under IAS 41, that is agriculture, cannot be considered under IAS 23. That is an exclusion to this standard. Is that okay? So these are the four basic exclusions under IAS 23. So after looking at the exclusion to this standard, then let's look at the components of borrowing cost. Okay, the first component is interest. Interest. That is interest on bank overdrafts, and interest on short-term borrowings, and interest on long-term borrowing. Okay, that is where business goes in for loan at the bank. There will be an interest rate on the loan. So if the loan amount is 10,000 and the interest rate is 10%, then 1,000 is the interest, and this interest forms part of borrowing cost. Is that okay? I keep telling my viewers that the theoretical aspect of financial reporting, corporate reporting are important. They can examine you on this, especially at the professional exams. Okay, they can ask you to explain the component of borrowing cost under IAS 23. So take note of this. The second borrowing cost I would like to talk about, but before I will even talk about the second borrowing cost, from the definition of borrowing cost, we learned that borrowing costs are interest and any other costs incurred by an entity in connection of borrowing of funds. So the two key words here are interest and any other cost. So basically we have about 5 different borrowing costs under IAS 23. So the first one is interest, and the other 4 is the any other cost from the definition. So the second one I would like to talk about is amortization of discounts or premium relating to borrowings. So we have amortization of discounts or premium relating to borrowings. All right. One key things I want you to understand is that when there is discount on external borrowing, discount reduces the borrowing cost and premium inflates or increase the borrowing cost. Is that okay? For instance, when a bank gives a loan to an entity or business at a discount, meaning that the entity or the business will pay the loan or the finance charge relating to the loan at a lesser value or lesser amount. And one key thing you have to also take note is that interest are always per annum and discount and premium are always for the entire duration of the loan term. Is that okay? So for instance, when there is a loan of $10,000 for 5 years and there is an interest on this loan for 20%. 20% on 10,000 is 2,000 as the interest, and there is a discount of 10%. This discount is also 1,000. But remember, this interest is per annum, and this is for the entire duration of the loan term. Is that okay? So if we are to account for a borrowing cost for 1 year, meaning that this 2,000 will be part of borrowing cost as an interest for the year. But when we are to account for borrowing cost for 1 year, considering this discount, because the discount is for 5 years, then we have to amortize the discount. That is spreading the loan over its useful life or the term of the loan, that is 5 years. Okay, so when we spread this, then we will have 200 as discount for every year, meaning that the entity will pay the finance charge at a cost lesser of the discount. Discount reduces the finance charge. So the borrowing cost over here, so to calculate borrowing cost, we have interest interest is one of them. Interest is 2,000. And then the discount, amortization of discount in relation to this borrowing cost for 1 year is 200. So we subtract and pay 1,800 as borrowing cost. So discount reduces the borrowing cost, then the premium also increases the borrowing cost. So if it happens to be premium, then this 200 will be added so that the borrowing cost will be 2,200. So the process of dividing the loan with its term is what we call amortization of discounts, okay, and premium. So basically that is the meaning. So discounts and premium form part of borrowing cost. So you have to take note that discount reduces borrowing cost, premium increases borrowing cost. And the next one we would like to talk about is amortization of ancillary costs. Amortization of ancillary cost in relation to borrowing or relating to borrowing. Relating to borrowing. So with the ancillary cost, sometimes before business will be able to raise money to finance their project or acquire an asset, they can do this in different forms. Some business will issue bonds, other business will issue debentures, and finance cost that will be in relation of the issuing of this bond or debenture is what we call ancillary cost. Okay, so example of this ancillary cost is what we call issuance cost. So example is what we call issuance cost. And this issuance cost could be a legal fee or audit fees. Another example could be cost of advertisement. Cost of advertisement. Before people will get to know about your bonds or debentures in the market, you have to make an advertisement. Okay, so all these costs you incurred in connection of raising funds to finance your project is what we call ancillary cost, and it forms part of the borrowing cost. But one thing you have to take note is that if an issuance cost is $2,000 for the entire duration of the loan, or the entire duration of the issuance of the bond, and is 5 years. If we are to find the borrowing cost per year, we have to amortize this by 5 years. So the process of dividing the cost by the years is what we call amortization of ancillary cost, because we know that amortization has to do with spreading the cost of intangible assets over its useful life. Okay, so the process of spreading the loan over the useful life is what we call amortization of ancillary cost. The fourth one I would like to talk about is finance cost. Finance cost in respect of finance lease. Finance lease under IFRS 16 leases. Sometimes business may need some non-current assets to undertake their project or activities, and because they don't have enough funds to do that, they go into someone we call a lessor to lease such assets to undertake their projects. So the finance cost in relation to the item or the asset being leased is part of a borrowing cost. That is where if the rewards and risks are transferred to the lessee substantially, if that condition prevails, then the finance cost in relation to the asset being leased will be considered as borrowing cost. IFRS 16 leases is a separate standard that talks about the accounting treatment for leases, and I've done this standard already on my channel. The link will be dropped in the description column below if you want to get the detailed understanding about lease accounting. The link will be dropped. So the fifth point I would like to talk about, or the last point I would like to talk about, is exchange differences. Exchange differences. Exchange differences. That is, exchange differences arising from foreign borrowing to the extent that they are regarded as adjustment to borrowing cost. So sometimes business or entity in one country will go in for loan in a different country, and the exchange rates may be different. For instance, when a business owner from Ghana going for a loan in UK, and the exchange rate is in such a way that every 10 Ghana cedi is equivalent to $1, and the business owner going for a loan of an amount of $1,000. So if the business owner in Ghana wants to pay this money in returns, meaning that the person will pay 10,000 Ghana cedis. But sometimes this is not the case. Sometimes before the payment of the loan will be due, there will be differences in the exchange rate. Is that okay? And these differences could be, for instance, there has been a change from 10 cedis to 12 cedis in every $1, meaning that the business owner in Ghana will pay 12,000 Ghana cedis in return. Okay, this same concept apply to the interest, meaning that if a business owner needs to pay 1,000 Ghana cedis for a loan, is that okay, at an exchange rate of 10 Ghana cedis, meaning that the business owner will pay 10,000, but if the exchange rate has changed to 12 cedis, meaning that the interest that will be paid will increase to 12,000. So this difference in amount is what is caused by exchange differences. So this difference or this increment of 2,000 is part of borrowing cost. That is what the standard says. Is that okay? So if there is an exchange differences arising from foreign currency borrowing to the extent that they are regarded as an adjustment to interest cost, then such differences should be considered as one of the components of borrowing cost. This is highly examinable. So in a subsequent video, we will look at the accounting arrangement for borrowing costs under this standard. We will also look at when to commence capitalization, when to suspend capitalization, and the cessation provision or cessation period, and probably the disclosure requirements of borrowing costs. Okay, so if you are yet to subscribe, I will encourage you to kindly subscribe to this channel. Comment on this channel for us to know how this channel has helped you. Until we meet for our next video, I think it is bye for now.